Welcome to the deep dive. Today, we're really digging into an industrial giant, Emerson. We're unpacking their Q4 and full year 2025 earnings results and, maybe more importantly, their outlook for 2026.
Yeah, and this is about getting under the hood, isn't it?
Right.
We want to separate what's real market momentum from, well, some temporary accounting stuff, especially around their software business, which is becoming a bigger piece of the pie.
Exactly.
We really need to look beyond just the top-line numbers to see where the actual investment is happening in industrial automation.
Right. So our mission here is to take all this dense earnings material, the call, the reports, and boil it down for you. We're focusing on their pretty solid underlying orders, some big wins they've had, and navigating that, let's call it tricky software revenue picture. Okay, let's start with the 2025 scorecard. It was actually Emerson's 135th anniversary in 2025, founded way back in 1890 in St. Louis.
Quite a history.
Yeah, and they wrapped up the year saying they finished stronger than ever and transformed. That's a bold claim considering all the global cycles they operate through.
It is bold, but, the operational execution largely backs it up.
Yeah.
Even if the headline sales growth was maybe a little soft, full-year underlying sales growth landed at 3%.
Okay, 3%. What was the drag there?
Well, they pointed to some unexpected softness, particularly in Europe and China. It was in what they call book-to-ship business.
Ah, the shorter cycle stuff.
Exactly. Projects ordered and shipped within the same quarter. That part was a bit weaker than they'd hoped.
Got it. So short cycle softness, but you said the execution was strong. Where did that show up? Because the profit numbers looked pretty good.
They were definitely the highlight.
Oh.
Profitability, cash generation,
Mm-hmm.
those were the stars. Their adjusted EPS, which is really that core measure of operating efficiency, it grew 9% year over year to $6.
That's solid growth.
And they hit an annual record on their adjusted segment EBITDA margin. That's profitability before all the interest, taxes, depreciation, amortization. It hit 27.6%. That's up 160 basis points, which is quite healthy.
And cash. Did that follow suit?
Oh, absolutely. Cash generation was, frankly, exceptional. It actually beat their own guidance. Free cash flow came in at $3.24 billion.
Wow.
Yeah, up 12% year over year. And that cash, that's really the firepower they need for this transformation and all the growth investments they're making.
Right. Speaking of transformation, those synergies from acquisitions seem to be kicking in faster than planned. Test and measurement hit its target.
Yep, the test and measurement integration delivered on its $200 million run rate synergy commitment. Done. But, like you said, the speed on the AspenTech integration really stands out.
It does. What were the numbers there again?
They got $50 million in synergies from AspenTech just in 2025. And now they're saying they'll hit the full $100 million run rate synergy goal by the end of 2026.
Wait, 2026? That's 2 years early, isn't it?
2 full years ahead of the original schedule they laid out.
Okay, that's fast. But is there a risk there? I mean, are they rushing it? Could pulling synergies forward like that potentially hurt long-term R&D or, deeper integration benefits down the line?
That's a fair question. You always wonder about that with rapid integrations, especially in software. But their commentary suggests confidence. They seem to frame it less as rushing and more as, well, efficiently capturing obvious overlaps because the businesses sit so closely together already.
So it's more about alignment than just cost cuts.
That seems to be the message. They want that single integrated industrial software platform sooner rather than later. Pulling it off does signal, I think, pretty depth domain knowledge to execute that quickly without breaking things.
Okay, that makes sense. And that strong cash flow you mentioned gives them the buffer to handle what looks like a really strong order book heading into 2026.
That order book is key. Underlying orders grew 6% in Q4. That was the third straight quarter of mid-single-digit growth. It really shows that major customers are still investing heavily.
And investing in what, specifically?
Automation, fundamentally. But for critical things, efficiency gains, improving asset reliability, meeting compliance needs, digital transformation projects. And if you look at where the money's flowing, they're designated growth verticals.
Power, LNG, life sciences, aerospace, and defense?
Those 4. Collectively, orders there were up 11% year over year. Really strong demand.
And underpinning all that is the recurring revenue from their massive installed base, right? That must provide some stability.
Huge stability. Their installed base is estimated at around $155 billion globally. And the MRO spend maintenance, repair, operations that stays pretty resilient through cycles. It accounts for about 65% of their total sales. It's really the bedrock.
Let's make this tangible. They mentioned some specific big wins, in power, for instance.
Yeah, the energy deal was significant. 3 more greenfield combined cycle power plants using their Ovation 4.0 control system. That's adding about 3.1 gigawatts of generation capacity.
That sounds like a lot.
It is. Think roughly enough power for a city like Houston. It puts Emerson right at the core of grid stability. Plus, they won a replacement job at the dual nuclear power station in Belgium, showing their role in critical baseload power, too.
Okay, and then LNG.
Yeah.
Big energy security play there.
Absolutely.
Yeah.
They were picked as a key automation partner for the Woodside, Louisiana LNG project. That's a massive export terminal, aiming for 16.5 million tons per year.
Mm.
In today's energy markets, these are huge, long-term strategic bets, and Emerson's controls are central.
The life sciences one also caught my eye. Supporting manufacturing for those new weight management drugs. That feels like a shift.
It does, doesn't it? Tapping into a massive consumer health trend. Automation is critical there for a couple of reasons. One, nearshoring these facilities demands rapid, reliable scale-up.
Right.
And two, they need incredibly precise control systems, like Emerson's Delta V, to ensure product quality and meet strict regulations as they race these drugs to market. Speed and precision are everything.
And they're funding this innovation push. They spent 8% of sales on R&D in 2025. What new software came out of that?
2 key AI-powered applications launched. First, Guardian Virtual Advisor. It basically combines their decades of process knowledge with conversational AI to help operators troubleshoot Delta V systems faster, reducing downtime.
Okay, practical AI.
And the second was Aspen Tech Subsurface Intelligence. It's a cloud-native AI tool designed to speed up seismic data interpretation for oil and gas exploration, helping find and produce resources more efficiently.
Let's zoom out again geographically, because there's a real split story, isn't there? Strength versus weakness.
Yeah, that continues to be the pattern. North America looks solid, India too, Middle East and Africa. They're expecting mid to high single-digit growth in those regions for 2026, driven by ongoing investment cycles.
Europe and China.
Still soft. The forecast for both regions in 2026 is basically flat year over year. That economic drag is proving persistent.
And they got specific about where the weakness is concentrated in discrete markets. Can you clarify what falls under discrete for them?
Sure. Discrete automation generally means factory automation. Think building individual products, machine tools, assembly lines. It's different from process automation, which is continuous flow like chemicals or refining.
Got it. So cars, machine building.
Exactly. And those discrete businesses finished FY25 up only 1%. They specifically called out ongoing weakness in automotive and general factory automation, especially among machine builders in places like Italy, Germany, and also China. That sector's still waiting for a proper rebound.
Now about that project funnel. They ended Q4 2025 with a huge number, $11.1 billion. But they also mentioned trimming it by about $1.5 billion. Why cut potential projects?
Well, this actually looks like smart risk management, not a sign of weakening demand overall. They took out roughly $1.5 billion tagged as sustainability and decarbonization or S&D projects.
Why those specifically did the projects vanish?
Not necessarily vanish, but the environment around them got shakier. Think about things like green hydrogen or certain large-scale chemical decarbonization plans.
Yeah.
The regulations, the subsidies, it became less certain. So they proactively removed some of those early-stage, higher-risk S&D projects that seemed less likely to convert soon.
Okay. So they de-risked the funnel by focusing on more certain projects.
Exactly. And the key point is that the growth in their core, high-probability areas, power, LNG, life sciences, semiconductors, aerospace, and defense, that growth offset the S&D reduction. So the total funnel remained large, arguably just higher quality.
Okay, this brings us to the software accounting dynamic. This seems to be causing some confusion around the 2026 guidance. It looks like a software sales headwind, even though they say performance is strong. Can you unpack that?
Right. This is purely about timing and accounting rules, specifically ASC 606, which governs revenue recognition for contracts. It mainly impacts the multi-year term licenses, largely from the Aspen Tech side.
So it's not about customers leaving or anything, just accounting weirdness.
Precisely. Think of it like this. 2025 was a really good year for them because a lot of high-value multi-year software deals happened to come up for renewal all at once. When those renew, under ASC 606, you recognize a larger chunk of revenue up front on your GAAP books. That gave 2025 a nice bump, about 70 cents to EPS. Now, in 2026, just by chance, fewer of those big multi-year deals are scheduled to renew. The customers are still tilling, the cash is still coming in steadily, but you don't get that same big upfront revenue recognition event on the GAAP P&L. That creates the headwind, an estimated $120 million drag on reported GAAP revenue for 2026.
That's a great explanation. So the reported sales growth looks lower than the actual business activity because of this timing mismatch. If GAAP revenue is skewed, what metric should we look at for the software business health?
You need to look at the annual contract value, or ACV. ACV smooths this out because it tracks the annualized value of all the contracts, regardless of when they renew. It's much closer to the actual cash flow reality.
And what's the ACV doing?
Well, they finished 2025 with ACV at $1.56 billion. And for 2026, they're projecting it to grow 10% plus. That double-digit ACV growth, that's the signal of underlying health you should focus on.
And critically, this accounting issue doesn't hit cash flow, right? And it should reverse later.
Correct on both counts. It does not affect free cash flow, which is vital. And yes, it's expected to flip and become a tailwind to reported revenue in 2027 and 2028 as more contracts come up for renewal then. It just distorts the picture in the short term.
So that 4% underlying sales growth guided for 2026 is more like 5% if you strip out this software timing effect?
That's exactly how they presented it, about a 1% impact from this renewal timing.
Okay, let's wrap with the overall 2026 outlook then. Total underlying sales growth guided around 4%, or that adjusted 5%, and adjusted EPS.
The range is $6.35 to $6.55 per share.
And how does that growth break down between the segments? Is it front-loaded or back-loaded?
It's definitely more back half weighted,
Right.
especially for intelligent devices, which is projected to grow 4% for the full year.
Okay.
That second half strength comes from backlog phasing. Remember those big power, LNG, life sciences projects, one in late 25?
Right, they ship later.
It's exactly. Scheduled to ship mainly in the second half of 26. Meanwhile, test and measurement is expected to keep up its strong run, likely high single-digit growth, thanks to momentum in semis, aerospace, and defense.
Finally, what about returning cash to shareholders and the balance sheet?
Big commitment there. They plan to return about $2.2 billion to shareholders in 2026. That's roughly $1.2 billion in dividends and another $1 billion in share buybacks.
And the dividend itself.
They announced a 5% increase per share. Impressively, this marks the start of their 70th consecutive year of raising the dividend.
70 years. That's incredible consistency.
It really is. On the debt side, they're also focused on deleveraging. The plan is to pay down about $1 billion in debt during 2026. The target is to get their net debt to adjusted EBITDA ratio down to around 2 times by year end.
Okay, so pulling it all together, what's the big picture takeaway for someone listening to this deep dive?
I'd say the strategic picture looks quite solid. You've got growth really tied to major, durable global trends. The need for more electricity, energy security driving LNG and power investment, and that push for nearshoring in high-value areas like life sciences and semiconductors, that's the engine.
But balanced against the macro drag.
Right. That strategic strength is just being partly offset for now by that known persistent sluggishness in European and Chinese factory automation. But crucially, if you look at the cash flow and that double-digit ACV growth in software, the underlying financial health looks stronger than the headline Jeep numbers might initially suggest because of that temporary accounting issue.
So it feels like Emerson is confidently betting on automation, increasingly powered by AI, to optimize these huge industrial systems worldwide, really leaning on that 135 years of domain expertise.
I think that's right. And maybe one final thought for you to consider. Building on that, we know Emerson's Ovation Controls manage something like 30% of global power generation capacity, and they see potentially $40 million or more in content for every new nuclear reactor built. Now, think about the absolutely massive and accelerating global demand for power driven by data centers for AI and cloud computing. These things are incredibly energy hungry. How might that sheer scale of new electricity demand further boost Emerson's power business, maybe even beyond their current robust projections? That interaction between industrial automation and the digital infrastructure build-out, that's a fascinating dynamic to watch in the coming years.
That is definitely something to chew on. Thanks for helping us slice through the complexity here. We'll catch you next time for the next deep dive.